Very good morning, my dear friends. The Narasimhan Committee had recommended way back in 1992 that the banking sector be organized in a way that it consists of a few banks which are large enough to be internationally competitive and meet all international standards. The committee suggested that merger might have been one of the tools to arrive at this. The consolidation of the PSBs in the last financial year seems, in hindsight, an offshoot of this recommendation. With the recent consolidation of the PSBs, the government has achieved the larger goal of achieving large and well capitalized banks with international and diverse geographical presence as envisaged by the Narasimhan Committee. Government desires that large sized public sector banks, which are functionally strong, professionally managed, and can meet the demands of growing aspirational India. To this, if we consider the announcement of the privatizing few public sector banks which were not part of the consolidation process, then we are heading for a situation where government will have reduced share of PSBs in the overall banking system. This is the best way to strike a balance between innovation, efficiency, competitiveness. We also expect that the health of the PSBs in general will improve as the size of the bank brings with it the scale of economies which entail lower costs of capital and funds, better geographical diversification, and overall financial stability. Globally, banks entered the pandemic with a large amount of capital and high liquidity buffers and have shown resilience so far. And unprecedented policy support has helped to maintain the flow of credit to the household and firms. However, profitability challenges in the low interest rate environment call into question banks' ability or willingness to continue to lend in coming quarters. Bank may be concerned about rising credit exposure and increasing non-performing loans once policy support measures end, especially where the recovery may be delayed or incomplete. Banks may also face challenges in generating return above the cost of equity amid continued compression of net interest margins, a development long evident in Japan and Europe. Reflecting unprecedented policy support, spreads have recovered almost entirely, even in the sub-investment grade sector. Interestingly, there is now a consensus that banking sector NPAs will not rise significantly, reflecting in part the stricter borrower discipline that the RBI and banks have assiduously brought about in the last couple of years. However, it may be noted that in India, the stress assets were declining just prior to COVID-19 outbreak. However, with the regulatory forbearance, the true picture is still not reflected in the accounts. Based on footnote on SBI quarterly 3 results, the difference in GNPA is on account of the Honorable Supreme Court judgment is almost to the extent of 67 basis point. Budget has announced creation of bad bank or ARC-AMC structure for purchase of stress assets from banks, which is a big positive. Further normalization of IBC is also on cards. Also, RBI allowed the option to directly invest in defaulted corporate bonds to FPIs, who could earlier only get exemption through investment through the security receipts and debt instruments issued by asset reconstruction companies, and debt instrument issued by an entity under the corporate insolvency resolution process. These exemptions are the short-term limit and minimum residual maturity requirement under the medium-term framework for investment by FPIs and corporate bonds. This will widen the market and will provide a faster exit route for the bondholders. RBI on the payment system notes that the decade of 2010-20 can be termed as the decade of payment in India. There have been many defining moments that transformed the payment ecosystem of the country and attracted international recognition. During the decade, the country has witnessed the introduction of innovative payment system, entry of non-bank players, and a gradual shift in the customer behavior from cash to digital payments. We have a unique, secure, and interoperable unified payment interface for retail payments, biometric based as well as QR code based payments. The shift in payment preference in the last 10 years is evidenced by the fact that the volume of paper clearing, which comprised of 60% of the total retail payment in the financial year 2010-11, has shrunk to 3% in the financial year 2019-20. This striking shift in payment preference has been due to the creation of robust electronic payment systems such as RTGS, NEFT, and ECS that has facilitated seamless real-time or near real-time fund transfers. In addition, this decade has witnessed introduction of innovative payment systems that provide instant credit to the beneficiary. With the launch of fast payment systems such as IMPS and UPI that are available to consumers round the clock for undertaking fund transfers, and introduction of mobile-based payment systems such as Bharat Bill Payment System (PPIs) to facilitate payment of bill and purchase of goods and services, and National Electronic Toll Collection (NETC) to facilitate electronic toll payment. Data shows that low-value payments dominate the volume and the turnover, and products that afford real-time instantaneous transfer are the most preferred modes of payment. The facilitation of non-bank fintech firms in the payment ecosystem and PPI issuers, BBPOUs, and third-party application providers in the UPI platform have furthered the adoption of digital payments in the country. Payment systems have always been regarded as a public good and an ancillary activity of banks which can be leveraged as a base to provide various other services. We should not forget that NPCI was an initiative of the banking industry and SBI was also one of the core promoters. Thus, the above developments augur very well for the banks. This because as direct providers of payment services, banks have not been left out, and today the latest technology is available with banks. Further, our collaboration with the fintech has created better customer experience and newer business opportunities. Perspective of banking sector, the COVID-19 pandemic has created many long-term opportunities. On the opportunity side, the new vistas of financial intermediation, leveraging on technology and new business models are rapidly emerging in India. API connectivity allows financial institutions to be agile, that is, to innovate and integrate new services faster while providing lower costs for their customers. By opening up to a more flexible infrastructure and simplifying the terminal software market, speed and time to market delivery have improved. Fintechs and banks in India have made considerable strides in adopting and promoting digital banking since the outbreak of COVID-19 pandemic. As the contactless services are in demand and digital mode is becoming the most preferred option among banks, a recent report of S&P note that India's digital disruption poses a relatively low risk to the long-standing position of its top-tier bank. Many banks in India have been quick to embrace new technologies to cater to a vast and growing young tech-savvy customer base. Both commercial banking and retail banking are poised for a major transformation as technology will enhance the user experience and speed. In retail banking, world over and India, banks are collaborating with fintechs to offer point-of-sales financing. The options to extend unsecured loans, both pre-approved and sanctioned on tap, are being explored. The blockchain technology offers a promising method to speed up KYC process. AI and ML tools are being tested to address customer issues and ensure seamless onboarding. In commercial banking, banks will have to hit the reset button on business practices. As the economic consequences of a global shutdown unfolds, companies' desire to preserve liquidity will be one of the defining features of the marketplace in 2021 and beyond. Before the pandemic, corporate strategy was driven in large part by the quest for operational efficiency. After COVID-19, operational risk will play a bigger role in corporate planning. Real-time cash management, end-to-end supply chain, and vendor financing using digital platforms are being recognized as key to operational efficiency and containing risk. Blockchain is being deployed to de-risk and speed up the trade finance business. Recently announced national blockchain policy will further accelerate the drift in this direction. The Union Budget 2021-22 has been majorly focused on capital expenditure. The centre is expected to undertake Rs 5.4 lakh crore of capital expenditure, mostly in core infrastructure such as road, urban transport and railways. Further, the budget has allocated around 2 lakh crore for urban local bodies for capital expenditure at state level. Thus, we are expecting around 7 lakh crore of spending of capital goods. Agriculture infrastructure has also got fair attention in continuation with past policy. Hence, from industry point of view, we can expect good demand in core sectors such as steel, cement, and fertilizer sector. The expenditure allocation in health is also positive for the sector. The business is expected in tier 2 and tier 3 towns where the demand is high and there are supply constraints. Also, renewable sector will have good traction, particularly in compressed biogas, solar and biofuel segments.